So when we kind of transitioned into this conversation about infinite banking, I just want to recap that what triggered all of this was we were at lunch and you were talking about capital gains and how annoying it is that you keep getting capital gains. And one of the things with insurance is it's able to offset taxes very easily for numerous reasons when used correctly. And it ties in with estate planning, which is something we're going to touch on a little bit in this. And also in cash value products, when they're designed and used properly, the growth inside of them can be tax-free, which is unlike pretty much anything else out there. And so the goal today is for you to figure out how and where this has a place in your portfolio and why. And the other thing, Trish, you were saying that you had said this to me at lunch, that when you looked at it through, I don't know who presented to you. I don't know if it was the bank or some sort of
No,
agent.
it was a real wealth formula. It was Buck Joffrey's team. He was selling the infinite banking thing. So they were telling me to use leverage. And then like they said, oh, like if you do this, you'll have a payout, like kind of like a pension plan. But when I had them, account for inflation, it didn't look much better. So I was like, well,
Yeah, from what you're
yeah.
describing and what you said to me at lunch, it sounded like they had presented to you not just infinite banking, but premium financing, where you're kind of leveraging through the bank, which is an extremely complex strategy, definitely not recommended. It's almost, I would say, don't ever do it. It's not necessary. And premium financing is one of those things that looks and sounds super fancy, and the hot shots will present it and it's very glossy, but people who are very, very good at what they do in insurance will be the first to tell you that that's not even necessary to benefit from cash value life insurance strategies. And the only reason they really do that is it can seem fancier and it can make it seem easier to participate in these, but what you're doing is really you're collateralizing properties, and you're collateralizing other assets that you have. And then what that does is it depreciates the potential gain in the cash value life insurance itself, because you're having to say, borrow it out of this, pay some fees on that. It's overly complex, and I would applaud you for seeing through that, number one. And the main thing to know that you don't have to do premium financing at all to do infinite banking. They're totally separate concepts. So I think what I'll start is, first of all, I'll just say hi, everybody, and thanks for coming. It's great to see many of you again. I'm Jennifer Burnham-Grubbs. You know me, I founded Quantum in 2012. I'm an insurance consultant. I'll talk a little bit more about why I founded Quantum when we get into the presentation. I know Trish, and I know some of you because I'm a co-founder of WOW as well, which is an organization dedicated to empowering women to increase their financial IQ through discourse and access to really good information through vetted and trusted people. It's an intimate and small mastermind, and we did a collaborative lunch with the MoFire Physicians Group. So we had a lot of fun at that lunch. It was lots of synergy. I think we're all on the same page in terms of what we believe as far as money and power. So thanks for asking me to help demystify this stuff for you. I've prepared quite a bit of information. I'm trying to keep it relatively relatable and simple, even though some of these things get pretty complicated, because at the end of the day, it's not rocket science. It really isn't. And I'm going to help explain to you how and why it isn't rocket science. I put in the chat these FAQs. We can probably get to them towards the end. And I have prepared something that'll talk about basic insurance concepts, like what is term insurance, what is permanent, all of that. But my understanding is most of you are somewhat familiar with basic insurance concepts. So what we're going to cut to first is just this whole infinite banking thing, get that demystified. Then we can go back and answer any kind of basic questions. I totally welcome Q&A and all of this. So let's just get started, and you guys dive in as you have questions, okay? It's not gonna come. Oh, you guys are muted. That's right.
Yeah, perfect.
Okay, let me put this into okay. So the concept of infinite banking, or becoming your own banker, it's not rocket science. And like I said, it's not new. It's been around because these cash value products have been around for a really long time, really well since the 80s and 90s, where not just whole life, but other kinds of cash value life insurance were coming into play, and they were being widely used and strategically abused to avoid taxes. And so a lot of this has been around for decades and decades and decades. The products themselves have continued to evolve since the 80s and 90s. And certain kinds of insurance products, I believe, are terrible insurance products that we should definitely not use because there's something so much better available now that there's no reason you would ever use a variable life insurance product, for example. And one of the interesting things is that the newer products have evolved even in the last 10 and 15 years. And so because some of the newer products are so much better, this resurgence of conversation about infinite banking has even more power. And also there have been things happening up in Congress that are making cash value life insurance even more valuable. So there's old concepts, and then there's new products, and then there's this sort of flow in how right now infinite banking is getting even more popular because it's even on TikTok. I have clients that I'll be in the middle of working with, and they'll send me a TikTok video and they'll be like, is this what we're doing? And I'll be like, yeah, that's what we're doing. So rather than teach you infinite banking, we can go straight to here. And we can literally just look at this, and I encourage you to read it on your own if you aren't familiar with what infinite banking is. Basically, this guy, Nelson Nash, coined the phrase, but he didn't invent it. He was just a whole life insurance salesman. And he explained how the cash grows inside these whole life policies, and then you can borrow the cash out and you're loaning to yourself. So you're being your own bank. Instead of having to put it in a bank and then borrow it, you can put it in your own piggy bank, which is this cash value life insurance policy. And he was using whole life for that. Okay. And I'm skimming through this a little because you all can read this also on your own if you really haven't heard of infinite banking until now. But the surrender value is what is always available to you inside of a cash value life insurance policy as your walkaway money. You can cash the policy out at any time and just take that money. So it's an actual asset. And then on top of that, there's a death benefit in any of these permanent products. And so because of that, the carrier knows that this is a real asset. And that's why you're able to borrow from it. You're able to access death benefit in some of the newer products now in the form of living benefits. These fundamental concepts are rock solid. And that's why the guy was successful. Calling it infinite banking was a great idea. It wasn't inventing it. It was just a better way of describing the value of cash value life insurance products. Okay. It's very liquid. There are, depending on the kind of product that you're going to be using, there are lots of different chassis in which you can structure how the interest is credited. Some of them are guaranteed. Some of them are not. We're going to get into all of that. But it's very, very liquid. It's not like when you buy Tesla stock and stock prices are low and you don't want to sell it. So you can't really touch it unless you're going to try to get a loan from the bank somehow against that. You have all the money in your policy all the time, and it's not depreciating based on what the stock market is doing if you use the right kind of policies. So it's even more liquid than, say, stocks are. Much more liquid, in fact.
So you can just basically sell it the next day if you wanted to. You just end it and cash out.
You could, but the first 5 years, your cash growth is not going to be as fast because they take back their fees the first 5 years. So usually with most of these, you want to wait 5 to 10 years to bake it before you even really want to think about surrendering. But the point is, once you learn how to do this, you're never going to want to surrender because surrendering is unnecessary. You can just borrow the cash from yourself instead, and it's far more advantageous. But we'll get into that. One of the things I loved about this article, and by the way, it's from the Corporate Finance Institute, which is literally a worldwide resource used by all the banks, all the private equity people, everybody in finance. It's one of the foremost institutes out there. Okay. And this article was so well written. So I really encourage you to go and read it at one point if you just want to recap on this. It said exactly what I think is great is, yes, you want to put a portion of your income into these. You don't want to go putting everything into this. You don't want to put everything in the stock market either. You don't want to put everything into Bitcoin. You don't want to go all in on anything. And one of the issues is sometimes you have these brokers that are coming with these huge policy concepts, telling you how much you can accomplish and kind of trying to compete in an either or way against all the other financial tools out there. And I'll be the first to tell you that that's the last thing anybody should ever do. I'm a big believer in diversification, and each thing is sort of like something you're going to grow in the garden for different purposes and different reasons. And insurance has a place, and we'll explain how and why, but one of the things I just loved was they talk about the percentages of how much you should be allocating into these kinds of strategies. So again, this is basically for you to know that even on the CFI Institute, it talks about infinite banking. It's very straightforward. It's not the same thing as premium financing, and it is a well-known concept. So the question would be why, if this is such a sort of solid foundation, why is there still debate? Why is this considered something that not everyone in the whole world either understands or does? So before I get into my real beliefs onto why that is, there are a few things I want you to understand, and we touched on a couple of them. Fundamental things about life insurance. That death benefit is 100% tax-free. A lot of people don't really realize that. 100% tax-free. When someone passes away, a death certificate is presented. Within 2 weeks, that check for $1 million or $2 million is in the hands of the heirs or the estate or the trustee, and you cash it and there's no tax on it. It's the only product that delivers with that much certainty and that much tax-freeness, okay, the way life insurance does. And because it's that way, because there's so much certainty baked into it, which is wonderful from planning perspectives, you can work backwards from a known in a way you really can't with most other financial tools. So with financial tools and investments, there's things that we're hoping will happen. There's things we don't have control over. There's risk. The market, everybody tries to predict it, but there's no crystal ball. In this, there is a known, and that is that when the person passes, that death benefit is passing 100% tax-free for the amount of death benefit you purchase. So you're literally paying, and one day $3 million will be infused into my estate tax-free. And the other thing we know is mortality risk. And the insurers are very, very good at that. So because they're very good at understanding mortality and morbidity risk, they get all the data. They're able to dial down premiums directly in proportion to what they know to be a certain person's health. And so they can fine tune these financial tools around a known risk and work backwards from there to provide a lot of other guarantees in terms of how the cash is going to be structured, the cash growth inside the policy, for example, or what your premiums will need to be. The other thing to know is when you're younger and healthier, when it comes to life insurance, you're cheaper to insure. So this is not like most financial tools in that you can get in any time off the shelf if you've got the money. You have to be insurable. That is a gotcha. There are people who want the product and can't get it. I have a client worth $25 million. He wanted the product, couldn't get it because he had a history of addiction, and they would not insure him. So your health is the ticket to entry, and the younger you are and the healthier you are, the cheaper your ticket. Okay, so when you learn about these concepts and then act on the earlier side of your lifespan, you access these structures with a far lower overall cost than if you wait to learn about them or do them in your 60s, where it becomes so expensive. And then, to your point, Trish, when you look at the cost benefit analysis, the equations aren't the same. The other thing to know is women are cheaper than men because we have longevity when it comes to life insurance. But when it comes to disability and long-term care, we're actually more expensive because we have wear and tear. We have babies, we work our butts off. We live a lot longer, but we take more damage. Another thing, sometimes I hear this, that life insurance carriers don't actually pay out the death benefits. All of the A-rated carriers and even the B-rated carriers, they always pay the death benefit. The only time a death benefit isn't paid out is if there's intentional fraud, or if someone had a policy, then stopped paying their premium, and then the contract was canceled. Okay, but there is no case where a life insurance carrier hasn't paid out a death benefit. So it's really just good to debunk that in case that was a thought out there. The other thing is these life insurance companies are all backed by the state. So even if a carrier goes out of business for some reason due to bankruptcy or whatever, your policy contract is still protected and will pay. But another thing to know is this doesn't happen because life insurance policies are actually very valuable. The cost and the benefit, it's all calibrated so well by those actuaries that if somebody's going to dissolve a book of business, for example, doesn't want to be it, they just sell their book of business to another carrier who happily takes it on and then gladly honors the original terms. I saw this in my very first insurance job. There were policies that had been placed 30 years ago, and 30 years later, it was a claim time maybe, and going through the file, you could see it had changed carriers 2-3 times. But when it was time to get the death benefit paid, whoever the new carrier was, sent that check. So that's just some stuff I want you to understand about how life insurance is a unique tool, very different from other kinds of all the cool different money tools there are out there. And you'll start to see how come this matters when we get a little bit further. So I said I'd tell you why I think infinite banking isn't something everybody does automatically if, you know, life insurance is so unique the way it is, and also because infinite banking is a sound concept. Okay, well, first of all, I think the elephant in the room, at least I know that a lot of people think this, is that insurance is sort of cheesy, boring, and there are a lot of bad actors. I know this firsthand. I worked at a boutique in Beverly Hills when I first graduated from Princeton, and here I was, this summa cum laude, like naive math nerd, and I was so surprised after just a little while of working at this boutique that these guys that had been doing this for 30 years, some of them were just like barely like better than like a carnival actor or something like that. One guy smoked pot, drove up and down Beverly Hills, Beverly Drive on his bicycle, and once a year would make a giant sale to somebody, and he'd live off it for like a year and a half. There were people that did all kinds of crazy things with illegal viatical settlements, and then even the nicest people there, the ones that were more kind of honest, I noticed that they tended to look at this as a sales process instead of an advisory and consultative process. And I was so surprised when I really finally understood that they were looking to see what was the most that they could sell, as opposed to what was the most value that they could deliver within a policy, and do the nerd work of actually tearing the policy apart and look for the math nuggets that proved where the money was strong. I was naive but shocked, and that's when I decided to launch Quantum. After, you know, several years I stayed there, I grew there, and I learned a lot. But eventually I was doing business the way I thought it should be done, and I was business successful enough that I was confident that if I went and founded my own firm, maybe I'd have a chance. And when I did, the business managers I worked with said, listen, Jennifer, all new business comes to you because you're the one who knows what you're doing. And that's because, okay, the truth is, even for the business managers, these policies is not just the bad actors, okay? The policies are also hard to understand. I've had seasoned business managers, literally people in their 60s and 70s and 80s, and they've seen it all, right? They'll admit to me that at the end of the day, these products are just confusing. And that's why it's hard for them sometimes. They'll literally just admit that. And
Yeah, I think that's why I didn't get into it, because it was like, oh my God, all these little bits. I mean, like,
mhm.
you know, there was a lot in the contracts, just even for my disability, you know. I was like, oh, do you want this rider or that rider? And I'm like, you
Yeah.
know,
No,
yeah.
see, here's the thing with riders. This is what bugs me. The riders are there to up the premium. You get all of these little nickel and dime riders. What that does is increases their commission. So if you're dealing with a crappy agent and he goes to New York Life or Mass Mutual and they are taught how to talk about it, they're taught to try to sell all the riders so you get more commission, which is horrible. Okay. It's not that the riders wouldn't pay out. The riders are there. But what you really want from a consultant is to understand which ones do I need, which ones are not worth it. And unfortunately, most people in this space aren't incentivized to do that work. It's too hard for them. They'd have to really understand and think and put things together in a critical thinking way. And most of them are not capable or too lazy. It's also really difficult, and you'll see in a minute, it's really difficult to compare various products against each other because you need to spreadsheet. Each quote is 36 pages. April can attest to this, the work we do. You take these 36-page quotes. First, you have to even design them. Then you have to spreadsheet. Then you have to compare. Then you have to fine tune. It's really hard work. And a lot of people don't have either maybe the mental capability or the inclination to work that hard. The stock market, I will say, is so much easier. And I think the stock market gets a lot of, it's an easy access point, right? We all have a 401k. I really like people to understand that the stock market, which gets a lot of respect, is so much easier than insurance because all you really have to do is gather assets. If you're a supposed financial advisor with Morgan Stanley or whatever, you just get that client, you keep the relationship sweet, And that's literally all you do. A software program does the rest. I have a client that wrote the software that the Morgan Stanleys of the world use to rebalance their portfolios. It's not your FA rebalancing your portfolio for you. They're just talking to you like they know what they're talking about, getting your assets, and then everything else is on autopilot. And yet you're paying them 2%, and it's a lot easier than insurance. So why is this stuff overlooked? It's difficult. There aren't as many good advisors in there. Access and entry to it is confusing, and it's not for lazy people. So there just aren't a ton of people who choose to do this sector if they're going to do it well. But I happen to be one of them. And why I created Quantum was I realized that there is so much opportunity in these. And since it's such a low bar and 90% of the people in my industry are not doing what they should, I chose to go ahead and see if I could create a consulting firm that focuses on, in the way I think it should be done. And that was in 2012. And thankfully, I've won, me, my team, the company I founded has won awards for what we do. We have all the highest net worth people in the country as clients, celebrities as clients, and we don't advertise. We just get the business because the business managers appreciate what we're doing, and we don't have to work that hard. I mean, we work hard on the analysis and consulting part, but we don't have to work hard to try and get the business in the same way that someone who's selling a lousy product does. And I think, Trish, what you sensed, rightly so, because you have amazing instincts and are so smart. I think when you're getting presented a concept by someone who maybe isn't the absolute best for whatever reasons, right? You sense that part of what you're seeing is making sense, and maybe part of it isn't. And intuitively, you're confused because you think part of this sounds right, but part of this just really isn't feeling right to me. And you don't want to act because you don't feel good about it. And now I'm going to kind of explain, and you're really going to be able to see. And there's no way I would have been able to explain this had you not asked for me to do this today. So I'm so happy about it and excited. You'll see why you've had that instinct.
Actually, it's because, a lot of people, like after you get to a certain amount of money, like everybody's always asking you to, oh, this is so good for you. This is so good for you. But I'm not very shy about asking people, how do you make money from it? How are you making money from it? And people like you will just tell me straight up, this is how I make money, and this is how you're going to make money, and this is a win-win situation for both of us. Like the ones who are just like straight up like, it's really hard because like you ask all these sponsors, okay, well, yes, all these tax benefits, why do you want to do this? If it's so good for me, where is it good for you? So you just want to make sure that like both of us is aligned. And some of it, I think insurance, because if you guys sell a lot of products, you guys get sent to boondoggles and like Florida and Hawaii for things for higher sales and all that stuff. And I know about that. So that's why I've been kind of like, like it doesn't sound quite right. And that's why I was like, oh, when you were saying, oh, I'll just do it without too much of a sales pitch. It'll be very transparent. And that's why I was like, oh, let's listen to you and have, because I'm pretty sure you're sick and tired of people bullshitting me too.
I hate bullshit. Actually,
yeah.
you and I think you're going to get to know each other a long time. So you'll get to really understand that and why. But I hate it so much.
Yeah, right. The bullshit factor is like, oh, okay, all right, yeah. So it's like sometimes you sit through these things and it's like that 60-minute, what is that? What is that? Timeshare presentation. Oh my God, it's
Yeah.
So
well, and it's good to have a good BS Geiger counter. I think, at WOW, I love some of the women in there have a great BS Geiger counter, and I have one of those too. And it's great because you can really figure out where value is when you have one of those. And that's how I am able to drill to the bottom of insurance products, because of my Geiger counter. And that's what I do. And maybe because I have that ability, I've been able to be what I am, which is a great segue to what is Quantum. It's a commissions agnostic insurance consulting firm. When I say commissions agnostic, it means I'm not allergic to commission. This is how I make my money, but I'm not deciding what carrier or product to show you based on how much money is in it for me. I'm looking at the products let's say academically, and I'm saying, okay, if I were a Trish, or I were a me, or I were a Joe, and I had these things and I wanted to sell for X, what would be the most efficient way to solve for X with my money using the different kinds of products? And I really treat it like a math puzzle. And what I'm trying to drill down for is highest value, which is best amount of coverage for lowest price. That's value. It's not shittiest amount of coverage for cheap price, because that's actually not going to work, especially in risk management. You need the real protection that's tailored around your situation. But within that, there are various carriers, various products. So I look at and compare all the different products against each other. It is a lot harder than just being a salesperson. Okay. And I do the math, I crunch the numbers, and then I figure out which is the most high density product right now in the market for index universal life, for whole life. And there's a whole team that supports how I do all of this. And I can't possibly do it alone. But what I do is I do the final crunching of all the comparisons, and you'll see an example, and then you'll really understand the value of quantum. And this is why it's so unique. Most agents don't want to do that because they'll just get paid less. They'll find the better health rating for you, which means your premium will be lower. They'll work harder and they'll make less. And then if they use the product that covers you better and costs you less, they'll also take home less commission. So they're going to work quadruple and make less money. And most people don't enjoy that. I love solving for value. I love helping people be empowered with money. So I kind of enjoy all of that. Plus, I know I have to be really good at what I do to have even a shot in this business. So that's where I have a huge edge. And I do make my money, and everyone at Quantum makes their money off commissions, but we're consistently solving for better value, which means lower prices for our clients. And we do work with every carrier that has an A rating or better, which means I'm not tied to any one company. I'm not tied to Northwestern or Mass Mutual or New York Life. I'm not trained by them. I didn't get picked up at a college fair and told to talk about talking points. I've worked in this industry since 2005. And most of what I'm sharing is stuff I have figured out, created, cultivated. And when I'm working with the best at what they do in my industry, we all do know the same things. So hopefully that helps. I'm happy to talk more about what we do, but I just want to kind of explain to you how commissions agnostic works, and that we're solving in this really bespoke way, which is so different from just teaching about. It's like, if you have a hammer, everything is a nail, right? It's not like that. We're not selling only one carrier stuff. So this is a huge chart. And this is like the secret sauce of the consulting work we do as your analysts when it comes to being a commissions agnostic consultant. Because this is a crazy chart and I'm going to blow it up and show you, I'm going to temporarily get out of the PowerPoint because I want to get into the actual chart so I can do that a little bit more easily. And then we'll come back to the rest of the PowerPoint. But what I want to show you, because I feel like showing this to you will make it so much easier for you to understand why all of your instincts, Trish, had been kind of going crazy when you were being taught things. Okay, you guys see my, no, here, hold on. Recording still going. Share screen. Okay, here we go. Okay, can you see this okay? I know
Yeah.
blow it up.
Yeah, blow it up a bit.
I will.
Yeah.
And we can zoom in. Okay, I'll try to,
Yeah.
okay.
I love number charts.
Oh, well,
this is the
the amount of work
best
that has
part.
gone into this. This is literally 15 to 35 different 36-page quotes from various carriers, distilled down into like the 8 or 10 here. So I can walk you through and really explain this. Okay. Infinite banking. Let's just say infinite banking is a given. The concept of cash value life insurance is sound. You borrow from yourself inside the policy. The money grows in the policy tax-free. The death benefit is tax-free. And because there's collateral in both of those, you have a lot of liquidity. Let's just say that that's the fundamental of infinite banking. Okay. The devil's in the details. Remember we said the guy who invented this concept of be your own banker, he was selling whole life? Okay, let's talk about whole life. The two top carriers, let's say right now, Nationwide and Mass Mutual. Okay, if you want to do a $1.5 million death benefit, you're going to have to put $24,410 every year for your whole life, to buy $1.5 million permanent death benefit. Okay. It will grow cash. The death benefit will grow over time. It's not going to have any long-term care in it or anything for you. Okay. But all that stuff will happen and it will grow tax-free. Now, if you want, now Mass Mutual is considered one of the best for whole life. If you want to save some money on whole life, you could do a nationwide. Okay. You'd do 17,000 instead of 24,000 for your whole life. And you'd still have 1.5 of death benefit. Now, your death benefit might not grow as much, okay? Your cash might not grow as much, okay? But you would still have that permanent death benefit. Okay. Now, just put that aside for a second, okay? Already you can see when you do a chart like this, you can see pros and cons of which carrier is going to give you more bang for your buck, depending on what you really want. Do you want more cash? Do you just want the death benefit? Right there, that's one question, right? If you're doing a permanent policy just to offset estate taxes and you don't care about the cash growth, then maybe you would do a nationwide. That's just an example. But then let's talk about variable life. Variable life is another kind of permanent life insurance, and it does not guarantee to promise you any kind of cash. Instead, it says the money that's inside your policy will be on the stock market. So when the stock market goes up, you'll get more. And when the stock market goes down, you'll get less. Okay, and it usually is illustrated like this one is. This nationwide variable life is illustrated at an 8% year-over-year rate of return internally. Okay, now 8% is pretty tough to get year over year over year over year for 40 years for the stock market, because the stock market, when it's up, it's great, it's 22%, but when it's down negative 22%. And it actually takes a lot of time to recover from that. So variable life insurance is all over the place. And you could have a policy that looks really great from the cash growth for like 4 years, and then the stock market plummets and all your cash growth is erased. When I was sitting at a desk in 2006 at my job in Beverly Hills, it was the beginning of the dot-com bubble. And all of a sudden the phone was ringing off the hook and everybody was saying, "Where's Marty? I need to talk to Landon. Where's Richard?" And all these people were calling irate because the cash value in their variable life policies was imploding. And the carriers were saying, "Oh, I know you said that, we said your premium was 17,000, but you're going to have to put in another 6,000 immediately or your policy is going to be canceled." And they're saying, "What is this? What do you mean?" And the guys at that office, they just didn't want to take the calls. They just were like, "Just tell them I'm not here." And at that moment, I promised to myself I didn't want to ever be on the other side of a phone call like that ever in my life. And I started getting really interested. Why is this happening? What's going on? And then one of them explained, "Well, we illustrate that it's going to be 11%, but then the market doesn't really do that. And so it doesn't show up the way it was illustrated. And then now the market's down, so it's losing its cash value." And I was like, that's terrible. Somebody should be much more cautious or responsible when creating projections. That was the early beginning of my getting really interested in this stuff. But anyway, suffice it to say, I believe variable life insurance is a never used product, okay? Some people might tell you otherwise, but I'm here to tell you my opinion is a never used product for various reasons, including if you're going to be in the stock market, which you will be, don't have a middleman. Just go in the stock market. Why would you also then have a very unstable death benefit tied, eating at the cost, instead of just put part of your money in the stock market with none of the guarantees, with all the highs and lows, and use your risk management product for the stability, okay? But let's just say, apples to apples, you want to get 1.5 million of variable life, 17,000 a year, lifetime, just like the other ones. The cash growth will look like it's almost the same as the whole life. The death benefit will supposedly grow a little bit better. The cash supposedly won't be as good as this Mass Mutual whole life, but it'll be better than this nationwide whole life, right? So you could, like, if you were just a variable life salesperson, you could be like, "Look, you should do this because this is going to be better than nationwide." But here's the catch. They're using an 8% projection and they don't have any mechanism for guaranteeing it'll be 8%. Even whole life, where they tout themselves as being really stable, on this one, they're assuming 5%. But that's not even necessarily going to end up being what it is, because they say, for example, the Mass Mutual is 4.2, 4.4. They literally say in the proposal, Dividends are not guaranteed, subject to significant fluctuations over the lifetime of the policy. Changes in dividends will change all non-guaranteed values as shown, and that they're currently running at 4.42%. 20, 30 years ago, dividends used to be 8%. They keep going down and down and down and down. They have been every year since the early 90s, and they're continuing to go down. So where whole life used to be widely touted, it is not the best product these days at all. And it's also way more expensive. Just to get 1.5 million, you'd have to put 24K instead of 17, like you would do here. Hopefully I'm not going too fast, but I just want to get to the good part. This is my favorite kind of product, and it's called Indexed Universal Life. It came out in 2008, especially because the carriers realized the disaster of what happened with variable life insurance. At the time, I was extremely interested, and all the other guys in the office didn't touch it. And I kept asking, hey, how come we aren't showing more of this Indexed Universal Life? It took me years to figure out it was because they couldn't understand it. It was new. They didn't know it. No one had taught them how to think about it or use it. And they just literally didn't glom onto it. I glommed onto it from the very beginning, and here's why. They said, you know what? All this stuff with dividends that we can't promise, or variable illustrations that are pie in the sky projections, which may not play out right, we don't want to do that anymore. We're going to come up with some other way. And they came up with these kinds of products that had rails on them. They'd say, look, Indexed Universal Life, you pick something like the S&P 500. When the stock market is up, we'll credit as much interest as that stock market's up to a point, a cap, and that cap is usually 8 or 10% or so. We'll skim off the top whenever there's something more than that. And in exchange, whenever the stock market's down, we'll eat all the losses for you, so you can never lose your money. And so your cash value can never go down. So instead, you're just going to lock in your gains every time. And it's like a slow and steady wins the race, always going up. And he was like, I know it's not as sexy as variable life. I was like, are you kidding? This is what everybody wants. This is what everybody wants. This is supposed to be a risk management product. This is not my exciting lover, right? This is like my stable, I can count on this thing. And locking in and always being able to go up is exactly right. So I loved this product. I learned about them early on. And then over time, they've continued to iterate. And so now they're one of, or if not the most high value products, if you're going to do infinite banking. And I'm going to just show you what I mean. On an Indexed Universal Life, if you took the same 17,000 premium, started with a 1.5, okay, this has the ability to achieve a 6.8% year over year consistently. And if you do a 30-year look back, it actually does. But even if you illustrate it at 5.72, okay, this 17K will get you 2.26 versus the whole life. So almost as much as the whole life, which this one is a BS number because it's never going to reach that. Way more even than the variable, and definitely way more than the nationwide. Even in 30 years, it's going to do a lot better than the other products. And even in 20 years, it's going to be doing better because the cost of insurance is lower than it is on whole life. So the 17 you're putting in is pushing farther towards growing the cash, and less of it is going towards just this death benefit. It will still grow the death benefit. It might not grow as much as this whole life, but it doesn't matter. And it will add a long-term care rider inside. So you not only have your cash growing, you have your death benefit guaranteed, but you can even access that death benefit as a living benefit if you become unable to do 2 out of 6 activities of daily living. Remember, we talked about women take more wear and tear and are expensive for long-term care and disability. This makes it so you don't have to get a separate long-term care policy. You don't really even have to get a separate disability policy unless you're very concerned about that, or in your profession, there can be reasons you might want professional key person disability, but it's just chock full of so much value. Now I'm going to show you something else. When you have a high value product, and in this case, I happen to use Midland because right now they're one of the best IULs. You can even do a product that's going to get you 1.5 million, that's going to get you amazing cash. And you don't have to do 17,000 for every single year. So it's kind of like I want people to understand, if they're going to do infinite banking, forget whole life, forget variable life. Let's go over here and then look at what kind of IUL you want and what you want to do for it if you're going to do your infinite banking. And just to help you understand, you could do 17,000, almost the same, 17,009 instead of 17,002 for 15 years. And then the policy's all paid up. You still get a $1.5 million death benefit. Remember, that pays out tax-free liquid. You can access that instead as a living benefit if you need long-term care. And you're still, even with just, call it 18,000 for 15 years. If you get this policy going, you're going to still have way more than you ever put into it. In 20 years, you'll have 366, then it'll like double the next 10 years. And then from there, it'll get even higher. And then all that cash is yours to use how you want to borrow or take out as pension sort of thing for yourself. Am I going too fast, or is this making sense, guys?
Can I ask a really quick question? Or
Yeah, of course.
hi there, I'm Victoria. Sorry, I joined a little bit late. That 17,000 annual premium, is that this may be a simple question. Is that pre-tax, post-tax?
Post-tax. Post-tax.
Okay.
Yeah.
And lifetime, that means, I'm sorry, one column says lifetime, the other column says for 15 years. I'm trying to discern between what those two things mean.
Yeah, I understand. When they say a lifetime pay, they're saying you have to pay this premium every year for the rest of your life until you die in order to have this contract that they'll pay out 1.5 million of death benefit, and that this cash growth will be inside the policy. If you design a policy that's only a 15 pay, then they're going to build your cash growth around having put 17,009 in only for the next 15 years. And then it's all paid up. You don't have to put anything else into it. And you're still going to have this cash. You're still going to have this death benefit. And if there's a long-term care rider, like I like to put, there will be long-term care as well. So it's far less.
Is a long-term care rider extra?
No, with Midland it's not, which is one of the reasons I love it.
Question. This is Christina. When you say that it's that 17,235 per year, that includes all the fees, right? Because there's fees early on.
Right.
And then as it goes longer, more of the money you're putting is towards the cash value.
Yes, definitely. All of these are net of any of those fees. Fees like that are all baked into the premium. So all you have to think about is that premium. The carrier takes out all that it needs those first 5 years and then starts crediting more and more and more towards the cash growth after the first 5 years.
Now, on the cash value, if let's say you pull from that cash value, then it takes away from the total death benefit, doesn't it?
Not always. That's what, when you get into infinite banking, cash value can be taken out as a loan or as a withdrawal, and it can be paid back to yourself or not, because you are your own banker. And there's a lot of strategy that goes into how and when you want to access the cash value and in what ways. And we will definitely get into that. The thing I really wanted to try to explain, and I know it's a little tricky, is that when you're going and learning about infinite banking, if you're getting the whole pitch from somebody who's going to tell whole life or someone who's going to talk about premium financing, it's not going to have the same value. Or if they're going to do it using a variable life product. And you as a consumer, you're not going to know, because you're not going to even understand, no offense, but just because this is very hard to understand and you'd have to spend a lot of time knowing and training in this to even know any of it. Okay, that a variable life product is different from an indexed universal life product, which is different from a whole life, which is different from a guaranteed universal. Already you're swimming. You don't know what they're showing you. So you can't understand the actual quality of the product being used. And so while they're spreadsheeting numbers, you can't even know for sure that you're getting a product where that 8% they're promising is real or just looking very pretty on paper. There are 35-page illustrations and a lot of fine print. Yes, exactly. So when someone like Trish is saying, I don't know about this, but then I still feel like some part of this makes sense. The reason some part of it makes sense is a properly used cash value product designed correctly, by the way, designed with the death benefit dialed on the lower side, as opposed to the higher side, for example, will dial down the cost of insurance. And that way, the less the cost of insurance in the product, the more the actual value inside that product grows. But the only people who are ever going to be able to teach you how to do that are people who are like a consultant like this that works with every carrier, can actually spreadsheet quotes for all of this, figure out what's going to be best for your situation, and then fine tune that. And that isn't the typical infinite banking sales process. On TikTok, it talks about this beautiful thing. I'm my own bank. I put the money, it grows tax-free, and then I take it out. Yes, absolutely. So if it's that simple, my point is, why hasn't it taken off like wildfire? Because if that guy's on TikTok and it turns out he's doing it with a whole life product, which 85 to 95% of them are, then when you get into the details, if you really get to the fine print, you'll be like, I'm really only getting 4.42. Is that really good?
That's exactly what I was presented. I was like 4.42, and then now I think like last year they just passed a law, a thing like some kind of law in Congress. This is now they don't even have to give 4.42. They only give 3. They have to just like those Mass Mutual products, they only need to give 3%. I'm like, 3%? Jesus Christ, why would I put money and put a fees in to just get 3 freaking percent? I was like, forget about it.
Well, the problem is whole life is, in my opinion, also an almost never used product. It's very
Yeah.
outdated, but 85 to 90% of the carriers. I hired a guy from New York Life that I thought was a really nice guy. He had his MBA, he went to Columbia. Okay. And I said, listen, I know you're coming from New York Life. We do things differently here at Quantum. Okay. I'm going to teach you IUL. I'm going to make sure, because New York Life doesn't even have IUL at all. They teach them only to do whole life and term, maybe some variable. So I taught him everything about index universal life. And I said, this is what we use for our clients. It's cheaper for them. It's better for them. And we don't believe in whole life. It's overpriced. Do you know what he kept doing? He just kept doing the same thing he was taught, because he couldn't wrap his head around the actual critical thinking involved. And because New York Life has this down to a science, and they can just get some slick talking points and teach you that whole life is valuable and get people to make money, and the commissions are higher, they're not really incentivized to do this work. Now, again,
Yeah.
and the reason this isn't illegal is that whole life is still going to work. It's not stealing your money. It's just not maximizing the value. Does that make sense?
Yes. So just a question, so like for the index life insurance, they use options to cap it on both sides, right? They put options in so that, you're kind of in the stock market, but then they kind of hedge the upside and they hedge the downsides, correct?
Yeah, and I'm going to show you
Okay.
that. Okay, we can.
Okay.
Especially from a time perspective, we'll leave this chart for a little while and then we'll go back to the
Okay.
PowerPoint. I think hopefully for now, people mostly understand, right? The whole point of why the devil's so much in the details, what kind of products and whether there's real value in it. And you have to do some real number crunching, right? If you're really going to try to see
Okay.
value
So
come out.
let me just ask a quick poll of the women. Okay. All right, women here. I told her that our average age is 45. On average, we have children that we care about, so do we want to have an illustration where we have a $1.5 million death benefit, or do we want to just have a policy where we maximize the cash value so we can borrow from it? Can we have a quick poll here? Are people
I would say,
where's the
Trish, having
chat?
done this a really
'Cause
long time, everyone's
I'm-
situation is a little
I'm
different.
interested, but I'm actually too, Trisha, what really actually also interests me, aside from the death benefit, because I know we're all doing our own investments and we're growing our wealth and putting it in our trust, and we've got some money to give the kids. But one thing that does concern me is long-term disability and long-term care. And what if I wind up in a nursing home? Will they wind up spending all the money to take care of me? And I don't have that. So that also interests me. I don't know what you guys feel about that.
Yeah. Okay. So can we do one illustration? If you could just go over it, the one where we minimize the death benefit, because we all have assets that we can give to our kids already. Almost all of us are in the well-to-do category where we can help our kids out. So the death benefits is like, we'll be dead. They can take care of the rest of the the stuff. So we're probably not as interested in the death benefit as we are interested in the cash value. Is that correct, people? Hello, people. Yes, cash value,
The good
cash
thing is,
value.
I'll tell you,
Uh,
you don't have to
uh-huh.
choose either or, because when you
Oh,
design a product properly, and again, this is something most people won't do, because the higher the death benefit, the higher the commission, roughly speaking.
correct.
So they're not going to show you a 1.5 million starting design. They're going to show you 3,
What happened?
6, 10, because that triples, quadruples their commission. But when you do an IUL correctly, or any cash value policy that's going to be designed correctly with a lower death benefit, the death benefit will automatically grow anyway, no matter what. And you'll still have long-term care, and whatever's left over will still offset estate taxes. So you don't have to worry about having $10 million of death benefit. It'll happen anyway. It's more a question of, if this is going to get me my long-term care, and this is growing some of my assets tax-free, so I don't have to pay capital gains on every single piece of my portfolio. Okay. It's, what do you have to play with? And then how do we fine tune that? And of course, everybody's health is going to be a little different, but I ran all of these for a female 45 years old who's healthy, and we'll get into what defines healthy. And you can see, if you do even 25,000 a year for just 15 years, you're going to grow some really nice cash in there. You're going to have about 470.
Can you pop up your screen again? Sorry.
Is it not sharing? Okay.
Is it, yeah, it went away.
And
I mean, I
and
love
just
your
another-
face and all that, but
Yeah,
yeah.
no.
yeah, and it's
you
just
mind
that those numbers are really small. My little old
here.
little eyes can't see it that well.
Okay.
And also, is there something magic about quote 15 years, or is there an option
Yeah.
for a compacted investment? Because we're used to making 25 to 50K investments at a time. 15 years seems like a longish commitment, not knowing what's going to happen in the future. I just wondered, because I've heard one that was 50K for 5 years before.
Yeah, you can customize these any which way you want. You can do a lump sum. If you have $200,000 sitting in a bank getting 0 or almost 0 interest right now, or in some kind of super unstable crypto, whatever, you can move it and do a design where you move it into your cash value life insurance strategy and do a lump sum. There's so much flexibility about that part. So please don't worry about that part as much as seeing the proportions of costs versus what we'll create for you, and then starting to decide what you like. And then again, this is something that's very customized. There's not one, even for, if every single person in this group was 45, your illustrations would still be different, because each of you will have a slightly different health history, potentially. Many of you might get preferred. Some of you will probably get super preferred. And some of you might just have some crazy thing in your medical history that makes you not eligible for preferred. You'd have to get standard. And that's just the way it is with life insurance. But just for example, the reason we say 15 years is for, if you're 45 and you wanted to fund a policy so that while you're getting close to early retirement, you're all paid up. That's what a lot of people like. So we do that just as an example, but it's not set in stone. So you could do,
Because I think some of us are planning on retiring earlier.
yeah. So you would, if you
I
really
know
want,
all of us are planning to retire earlier. What are you talking about?
well, and then the question,
No.
do you really?
Amen.
want
Some
to
of us
save
are
up?
more desperate to retire.
I think collectively we should just all buy an island at some point.
Yeah,
Jennifer,
that's right. That's right.
Jennifer,
already
We
in the
were going to
plan.
name it. Yeah, it's
Jennifer?
already in the plan, and with a yacht too. We have.
do you
we
mind
have
if I ask a question about the modified endowment contract?
Yes,
Because
sure.
you were saying there's a difference between a loan versus withdrawal.
Yeah.
When you have the cash value. And
Mhm.
then I know that there's a limitation, because if it's too large, you could be taxed for, being an endowment. Could you explain that to us?
Yes. So in the 80s and 90s, people realized that cash value life insurance was the best thing on earth. And so they would take $1 million, put it into a policy for $1.1 million death benefit, grow the cash so fast, take it out in the form of loans to themselves, tax-free. And it was a giant loophole. And so the government eventually said, listen, this is a little crazy. We like cash value life insurance. We love this. We support this portion of the economy. However, we're going to put some guidelines. It's got to really still be a life insurance policy. So there's a rough 7-to-1 ratio as far as the cost of the insurance and how much you're stuffing into it. It's a very complex thing to try to explain what is a MEC, but just think of it as if you have the cash grow too quickly, proportional to the death benefit, it can turn into a modified endowment contract, and then everything over the basis becomes taxable. So you lose that capital gains loophole advantage, and you don't really want that most of the time, because that's one of the best things about this. So because we're starting with lower death benefit, because we want the cost of insurance low, we can't stuff it full of too much money too quickly, because otherwise it could become a MEC. So if you came to me, and I have clients like this, they're like, okay, I want to put in $179,000 a year for 20 years, then no problem, but the death benefit can't be 1.5. It's going to have to be higher, or else it would become a MEC. If you say to me, okay, I want to do 5 years payments, then I want to be all done. I said, okay, great. How much do you have? What can you put in? And then we would say, okay, I have 100K. Then we would dial this death benefit down as low as it can be without being a MEC to maximize the strategy if you wanted to do a 5-pay. It's all very customizable. And my job is the dialing part, because this is what I do for a living, and I know how to get it close down so it's cheaper, but not so close that it could turn into a MEC. Does that answer your question? Hopefully, Catherine?
Yeah, that was helpful. Thank you.
Okay. And just going back, all of these products are going to have the long-term care, and this long-term care amount, which grows, by the way, is payable for 4.5 years. So it's actually 479 a year times 4.5, because it pays out for 4.5 years. So it's closer to about $2 million of long-term care. And if you don't use all of it up, it's not forfeited. You could use half of that amount, and then it would last 9 years. Okay. Or if you use long-term care for a long time and then the person passes away, whatever wasn't used up is paid out as the death benefit. So it's a really flexible way to have multiple bases covered with one really strong product, instead of, again, an insurance salesperson would be like, oh, and you need long-term care. Oh, and you need disability. Oh, and you need whole life. Okay. But if you're working with someone really committed and agnostic and smart, you do not need all three of those things. You really don't. And then your money and your investment is going to go a lot farther. And it's like the avocado of an insurance product. It's so nutrient dense that it blows the value out of the water, versus these other ones where there's still value, but it's full of junk food.
So just a question, Jennifer, so for us who have spouses, it's great if both spouses are women, but my spouse is, slightly fluffy, white, guy who's still young, and he hasn't, what happens to him? Do I not have him have long-term care insurance, or can my long-term care insurance be used for him? How does this work?
There are a lot of different long-term care products, and Quantum is an expert in long-term care. For this particular audience, this group of 45-year-old females, don't buy a separate long-term care policy. You're too young, you're too healthy, and traditional long-term care premiums are not guaranteed. So even if you buy it right now, by the time you use it when you're 83 or so, the rate on the policy you bought will have quadrupled, which is terrible.
Oh, okay.
So if you're 65 and you're only just doing your long-term care, you might be so unhealthy and or advanced in age that you can't do an IUL. Then the costs are all off again. It's not going to be worth it. You
Okay.
can't do an IUL when you're 65 for the price you can do it when you're 45. So then that person, maybe they should just get a standalone long-term care.
From an
Yeah.
a state standpoint, I did understand, I was looking at the rules for California, that permanent or index universal life insurance would still be available to creditors in case, like you had a lawsuit against you and they're going for your assets. Is that true?
Probably. Those creditors are certainly going to do whatever they can, and they're dialed in. Again, it's just a question of how smart is the person asking the question and doing the hunting. I do want to say something. Kathy, I think Munji is Kathy, right? I think. Is that, I don't know, Munji said that the long-term care insurance payout is terrible. No, I think you might be reading the chart, which is a complicated chart, without understanding on that illustration. I'm just going to show you some of these illustrations.
No, I meant the traditional
Oh,
long-term
yeah,
care.
yeah, yeah. Oh, yeah, 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 yeah.
Yes.
Yeah, 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 yeah. Well, the traditional long-term care market has really gone downhill because people are living too long and the carriers are actually exiting the market. They don't want to cover long-term care. So it's really interesting the way long-term care riders are really valuable. And the way they started was during the AIDS pandemic. These wealthy gay men were, dying, but they had millions of dollars in life insurance. And they went to the carriers in the 80s and said, listen, I'm dying. You're going to pay me $2 million the minute I'm dead in tax-free liquid. Please give me $500,000 right now so I can buy that HTZ medicine and that might work and I might not die. And then you won't have to pay me 2 million and we both win. Well, the carriers were like, you have a really good point because they get more premium and they pay the death benefit out later if you live longer. So it's like a win-win. So that was the beginning of what eventually has evolved now into these living benefit riders that can be very valuable as a form of long-term care. And that's one of the ways we beef up the value in our designs. And I just want to say in this chart, which I'm happy to send, you'll see it can be really confusing because you have two parallel things. You'll see 1.5, everything's the same. You're doing 103 for 15 years in both. All that's different is in one of them, you're going to start taking out your income at age 65. You'll draw out $366,000 a year for the rest of your life, which is an option. You don't even have to wait to do it at 65. This is just an illustration of what you could do once you built up this cash. And the other is without showing a withdrawal or distribution, it shows how the thing grows and what you will have built up. And you still have the access to all of it however you want. But one is showing just a realistic picture of, okay, well, if you did this funding strategy, here's what you would get for retirement income, and you still have this. The reason the long-term care looks lower is because it technically is drawing down the death benefit a little, but there is a rider you can elect where you actually get your full long-term care. That's getting really in the weeds. I don't want to get in the weeds too much with this, but this chart is tricky. And if you were really going to be serious about looking at this chart, don't do it alone. I'm here to help you guys understand all of this stuff. Eventually give some lump sum examples. Yeah.
And that
The lump
income is
sum.
tax-free? That income is tax-free? At
Yes.
65?
Yes.
Okay. Wow.
Yes. So think of it as the IRA, the Roth IRA on steroids kind of thing. We talked a little bit about indexing and how that works. This is just to show you what I love about it is this is Midland, for example. This is what they said that they would deliver and what they actually delivered. I like that those match. And that's because an index strategy has rails on it. They can't screw it up. They can't screw it up too badly. This shows the interests that have been credited even in down years. Okay.
Oh, wait. Your screen's not up. Your screen's not up.
Oh, darn it. Sorry. Okay, hold on. Let me go back into, I'm sorry. Thanks, guys. This.
Yeah.
Okay, see this? This is what they said that they would do in the dark blue, and then what they actually did in the light blue. Okay, which is what I
Okay.
like. And then this shows in the years where everyone else's dot-com bubble, market crash, mini recessions, everyone's losing their money 20%, 30%. These you just get your floor. And it can be a floor of 0, it can be a floor of 2%. That gets again into the real weeds of which carrier, which fund, all that stuff. Okay.
But you don't lose money. You
Yeah.
just don't grow.
Yeah,
correct?
in 2008, to have just 0 as opposed to -20, people
Oh,
were
yes.
thrilled for that. And which is a
I
little
think I was -50 or something like that. at a
yeah.
point.
By the way, I have a friend and client. She's a member. Well, she's with a financial advisor. They have over $1 million in assets, and he just moved everything into cash. He's still taking over 1%, and he's doing little trades here that they still churn and get the trades on that. So they're putting her in cash, supposedly so that she can't lose any more than she already have, and still taking their fees off of it. Okay, your financial
And then you lose to
advisor-
inflation too.
Yeah, and you're paying him fees to put your money in cash, like stuff it under a mattress for you, and you're paying him 1%. I don't understand that. I don't understand why people put so much of their money in the stock market, except I think it's just because that was what we were all first taught. That was like our basic entry point into money. But if you're a little smarter, you think, okay, what can I put into this instead so that it's going to be a hedge? This is what I like about it. If this is your stock market assets, they go up, they go down. I always say it's like a bipolar relationship. It's got the highs, it's got the devastating lows. It's really erratic. The IUL is just this. It's slow and steady. And why that's amazing in terms of diversification is in the years when the market's down 20-30%, your IUL's not, it's still high. So rather than, let's say you're retiring and you happen to be like those poor Enron people who they lost 30% and then it was retirement time and they just had to take the retirement income out. That's all they had. And so they had to draw it out the bottom. Well, if you've diversified and not everything's in the stock market, then some of your cash is still going to be riding up high. And you can take that out without having to touch this till it's higher up. It's a total next level diversification strategy. Does that make sense?
Jennifer,
Yeah.
Okay.
does the income that you get for the one that you said, which was like 300,000 at 65, does it add towards your net investment income? That percentage, you know how they say that then you get a taxed additional on top of any over the net investment income per year?
This is tax-free income to you. There's no capital gains on it. You paid with this money was post-tax. So this is all, this is like, it actually takes me to
Question.
something I wanted to take you to. So there was this big kerfuffle. It's on the
It's like a
FAQ,
Roth. It's kind of like getting
just
into a
like a
Roth,
Roth.
even
Yeah.
though
Yeah.
you're
And then the
income
thing
out.
is,
limitations,
Jennifer,
though.
the only Jennifer, the only thing is like so it goes up by 8%, you know, like and you know, when I was looking at it, they were trying to do premium financing.
Yeah.
So it didn't keep up with inflation. So I think because on average, this thing is, what is the average rate of return for this of growth of this?
On a 30-year look back with Midland on an IUL strategy, if you look at every index for the last 30 years, it was 6.8%. We
Is
illustrate,
that net of
Okay.
fees?
yes, all net of fees. Now,
Okay, so it's basically higher than the general inflation rate. Yeah, okay.
yeah, and we illustrate at 5.72, just so that if anything, people are happily surprised, because I don't want people to be ever in a situation where the number was like 11%, but was going to end up being 5%. So the illustration numbers were really not right. So we, if anything,
Yeah.
like it to be under promise, over deliver. And I wanted to, someone who said that this is just like the mega IRA. So there's this guy, Peter Thiel. Did you guys hear about this guy?
Oh, yes, I did.
Jennifer,
Thanks.
back to that question, I guess for then this net investment income tax, even though you're not taxed on the 360,000 that you draw as an income per year, would it account to the total? So then that anything else that you make in income will then be taxed at that higher rate? That's what I'm trying to figure
No,
out.
I mean, you really, when it comes to your accounting work, I'm not the accountant, but my experience is my tax-free income is my tax-free income. It's like my HSA. If I have put my money into my HSA, okay, then when I take it out when I'm 65, it's mine and it already grew and it's not going to be my taxable income. It's just like another Roth. And so you pay, and that actually, so I would say definitively no, but double check with your accountant about that question, because I'm really not an accountant. But the whole concept is with taxes, you pay now or you pay later. And it's really interesting because right now we're in a historically low tax period in the United States, believe it or not. We all hate taxes, but our taxes are actually extremely low. So there's this whole thing you think about is like, well, you want tax deferred right now. You want pre-tax, right? Well, guess what? Then you grow it, it's big, it's huge, and then you're going to pay it 2039 tax bracket, which is possibly going to be way higher because the government right now is spending 98 cents of every dollar we pay in taxes towards interest on its own debt. And they just passed trillions and trillions and trillions of dollars in aid. And they are running a little bit on fumes, and they're going to have to start recouing. And so that they have, and also all along, we've been in a historically low estate tax situation. So about 12 years ago, they passed a little sunset period where you could have up to $22 million. Okay. And you still didn't have to pay a dime of estate taxes when both of the parents passed, assuming it's a, let's just say in traditional, right? So if you have $23 million when you die, you leave your heirs with a $1 million problem, and they're going to pay whatever, 30-40% on $1 million. That's not that bad a problem. Okay. Guess what? That was a temporary honeymoon, always scheduled to end anyway. And on December 31st, 2025, the honeymoon is over and it goes back to what it used to be, which was 12 million. And they're going to adjust it, they think, for inflation. So we pretty much believe it's going to be 13.6 or so will be the new estate tax limit. Well, in California, a lot more people are over that threshold. And every dollar that your estate is worth over 13.6 million is taxable immediately to your heirs. So what happens if you have a $30 million estate and you've done no planning? Your kids, they have to come up on the spot with $20 million worth of estate taxes. Well, whatever, the 20 million, it'll be 30 or 40% of that. Then there's fire sales of family properties you wanted to keep. There's immediate liquidation of assets. That's part of where life insurance and estate planning always go hand in hand. And what's really interesting is because we were in this honeymoon period where you could have $22 million, it really didn't feel like it was a problem for the last 10, 12 years. So it hasn't been in a lot of conversations, but I'm actually presenting with the California CPA Society next year because the business managers, they're not even thinking ahead about it. And it's really we who have to help remind them and say, hey, you better start thinking ahead because they're going to want permanent life insurance. They're going to want to set up the ILIT, irrevocable trusts. Okay. And the sooner they do it, the better, because if they're older and sicker, it's going to cost even more. So there's a planning piece that goes into it, which is why it's really nice to have permanent death benefit anyhow, if you're going to have a large estate. And then if you're going to have to spend on permanent death benefit, if you can make the money inside of it be working for you the whole time too, it's like very chock full of benefits. And it's all so different from other kinds of investment and tax concepts.
Can I ask a question? Is there a specific age where you can begin to draw it? I mean, obviously you want to let it grow, but if you choose, like say for the people that want to retire in 5 or 10 years, so is there, obviously that will decrease the end because you're, but it's not like a 401k where you can't get it to your 59, right?
Exactly. No, it's very flexible. So it's a question of how did you fund it? How fast did it grow? And what's in there? And then I say it's like a bloodletting. You can take out little bits and let the principal keep growing if it's performing really well. And then just do like a little bloodletting and it's supplemental income, right? And that 12,000 a year for the rest of your life, if it wasn't that huge a policy. Or there's another thing you can do. A lot of people, they put these aside as part of their college savings strategy, knowing that in 20 years, they're going to take a chunk or two out because that can be taken out as a loan to help pay for college for their children. Then they'll probably pay back a little bit over time so they don't deplete the whole thing and they let it keep growing again. And then they'll take out again when they're like 65 or 70 or 55 or whatever. But you can touch the cash value anytime you want. You can surrender the policy anytime you want. Remember, I said surrendering is almost never your best bet because if you're getting a policy like this from Quantum, where it's the lowest premium you can possibly get, the best health rating you can ever get, all that stuff, you're not going to want to dissolve this policy. I get second opinions sometimes where a policy with the wrong product, poor design, whatever comes, and then sometimes we replace that. But generally speaking, if it's well designed, no, it's irreplaceable because you're older now. You can buy the same thing off the shelf. It's too expensive or it's more expensive. So instead of surrendering it, take the cash out, take it as withdrawals or take it as loans or a bit of both. And it's very calibrated based on your specific scenario at the time and your own strategy. Some people are like, well, I'm chock full of money in there. I'm taking a bunch out to buy a new property because my interest rate is a net zero interest rate in my cash value IUL. And otherwise the bank would want to charge me 4%. There's all kinds of things you can do. They're very flexible. As long as you're not it's like bloodletting in that if you take too much blood out too quickly, you might amputate at some point. And so the question is, do you have to amputate or is it better to just take the blood out and let it regenerate?
Is there a specific bank you work with or you work with different banks?
Well, the carriers are not banks. They're actually carriers, right? We don't work with banks. Being your own banker and infinite banking has actually nothing to do with a bank, with Morgan Stanley or Bank of America or First Republic. Only premium financing has to do with the bank. And I don't recommend
like, where is the money held?
Oh, it's held by the carriers.
Okay.
And they own tons and tons of real estate. They put a lot of the money into bonds and the rest they put into derivatives. And that's how they're able to guarantee that they'll have enough to meet the minimums. And then on the derivatives, when they do well, they skim off the top and the rest can go into the interest that they promised.
And you said it's insured up to the full price of the policy?
Yes, those are death benefit contracts that they have to pay out on death.
Okay. Got it.
Yeah, those are good questions. I'm actually leaving for the airport in about 5 minutes, so I think I should.
Yay.
Am I still sharing my screen right now? Can you guys see this? What I wanted to share is, funny enough, this is not an aggressive product. This is on the risk profile. This is like middle of the road. Aggressive is like the market compared to this. And conservative compared to this would be, instead of doing an IUL, you would do a GUL where they promise they're going to give you 2.5% year after year. You're too young to do that because 2.5 is good, but you're cutting yourself a little short. You could do something better than 2.5 if you're in an IUL. So it's like a Goldilocks for this age group. It's not too conservative because sometimes for too much guarantees, you pay with opportunity cost. And I just want people to understand this is actually a safer, more secure, and far, far more guaranteed product than whatever you have in your IRA today. Okay, in terms of product profile and where does this kind of insurance product fit in to all the other things we do with our money. And that, I think, is that as far as the PowerPoint. On the FAQs, there were a couple really good FAQs that Trisha had asked, and we kind of went through them. Oh, that's not the FAQs. Let me just get the FAQs. Okay.
When is the typical time when you can start to pull from the cash value?
The first 10 years. I mean, after the first 10 years. I really teach people to really try not to touch it for the first 10 years if you can help it.
If you do it before the 10 years, like with the Roth IRA, you would get not a tax, but you would get a penalty for that. Is there like
Kind of. They have what they call early cancellation penalties and early surrender penalties and a few other early penalties that eat at your cash growth the first several years. And more importantly, it's one of those slow to ramp up, but then at the end, it's really accelerated kind of policies. So if you start drawing out too soon, you slowed its momentum before you really got the benefit of being in a Tesla. Does that make sense? Yep. So yes, the growth definitely is far outweighed inflation, because if you think about the death benefit, that's often like a 1000x return. If a person dies sooner than they expected, like talking about outpacing inflation, you can't fight with death benefit. Then if you paid on a death benefit product of $1.5 million, premiums for 5 years of $15,000, and then God forbid a person passes away unexpectedly, the return on that is through the roof, right? If you live a long time, the growth in the policy is through the roof. So either way, you're always going to do far better than inflation. Again, these are very much like the IRAs, which the problem with IRAs, though, people are starting to have a problem with it up in Congress, because the very rich people really understand the beauty of a Roth IRA. I pay today, like Peter Thiel, $1,700 into my Roth IRA. I grow it into 5 billion and I get all 5 billion of that tax free. That's ridiculous. It's awesome, right? So very rich people, well, we're included in that, but even richer than us, they understand how beautiful it is to bite the bullet and pay your taxes right now to have it all tax free later. And in fact, because that's becoming such an issue, and we saw in 2020, 2019, 2020, the statistics, more and more people are getting the hang of that. And now Congress is going to potentially go after them and try to put some limits. But the nice thing is, conversely, they passed benefits for the life insurance industry, and they are not going to be going after those. And they just passed what was a modification to code 7702, which is I'll include that in some follow-up documents, but they now allow you to grow the cash inside of your cash value product just a little faster than before without it becoming a mech. So while they're favoring life insurance strategies, they're potentially circling around, cracking down on Roths. I think we talked about the fact that these products, the kind that I prefer, the index kinds, they can't lose your money versus the variable ones can. And just to kind of think about this, your IUL doesn't have to send you a quarterly report. on how the policy is performing. It's not required to, because it's impossible for it to have lost your money. Your FA and the SEC require someone to be notified every quarter how their investment's doing, so that there's time for them to cut bait if it's falling, so that they don't get sued, so that someone can't say, hey, you didn't tell me my policy was not my policy, my fund in my IRA was tanking. They send those quarterly reports out as their own CYA. Okay, that's not even necessary in these products, because the money can only go up. I know that sounds maybe hard to understand, but for me, that's huge. Oh, how to offset. So the whole idea of trusts, and we can do a separate presentation. I have one I did with an estate planning attorney, but when you set up an irrevocable trust, dollar for dollar, every dollar of death benefit that's owned by that irrevocable trust will offset estate taxes. Okay, so you put anything into that eyelet, and then if you use death benefit inside that eyelet too, you're setting yourself up for millions of dollars of tax avoidance. And we can talk about that anytime if someone has serious questions about it. Oh, and what determines good health, bad health? There's a real underwriting process to all of this. The main things they look at is your blood pressure, cholesterol, RX history, BMI, and your age. If there have been urgent care or ER visits recently, sometimes that can impact things. But if it turns out that it was a big nothing burger, usually it's not a big deal. Mental health is usually not a big deal. They have pretty much no problem with someone who's very stable and takes, something for anxiety or depression, as long as it's stable. If something's recently diagnosed, not just mental or anything, but any kind of conditions are more recent, they're a little more skittish. It's not like they'll decline. They just might rate you preferred instead of super preferred until they see some stability. If there's suicide in the medical records, like suicidal tendencies or mention of suicide, they do get very skittish, and they'll rate pretty severely for that, because suicide's even covered. So they don't want to be on the hook. So after the first 2 years, even suicide is covered. There was a case where a guy waited 2 years and 1 day and then blew himself up, and then the policy paid out. So yeah, but generally speaking, the more transparent you are with your broker, and you tell them all you've got, and they should ask. We work with all the carriers, right? So we know which carriers will let you take edibles once a week and still get preferred health, right? And which
Jennifer,
ones
can I ask a quick question? When you were talking about the trust, should you set up the trust, irrevocable trust, before you buy the policy, or it doesn't matter?
Oh, for an irrevocable trust, you definitely don't, if you can help it, want to get the policy and then transfer it to the irrevocable trust, because then there's a transfer of value that can offset the tax advantages if somebody were to pass away 3 years within the placement of the trust. So when I'm doing eyelet work, typically, if we know that's where we're going with this, we get an estate planning attorney right away. They work with the client. It usually takes somewhere between 2 and 4 months for them to figure out exactly the whole eyelet. Sometimes they fast track it if the business managers are hustling. They're like, we need this done. But let's just say it's a 2-month, 3-month process. We get all the planning part of the insurance done, but we don't actually do the application and get the approval until we can name the owner of that policy as the trust itself.
Oh, thank you. Thank you for clarifying that. That was helpful, because
Yeah,
I'm thinking that. Okay.
Yeah. I know we went through a lot of info, guys. Thank you for your attention spans. It's nice speaking with a bunch of genius women. That always makes it easy.
Right back at you.
Oh, yeah, and if anyone has other questions, just find me. As you can tell, I really light up about this because this is the little corner of the world I've been able to figure out and crack, and it makes me really happy. It's so hard to explain what I do unless I got a forum exactly like this where someone's ready to sit and look at my spreadsheet. So if you guys hadn't asked, I may never have been able to teach you all of this, and thank you for asking.
Thank you, Jennifer,
Thank you
for taking the time, to explain this, because it is a complicated insurance product that a lot of people don't really understand well.
Yep. And all those bad actors, they don't help the thing. And that's personally my mission, is just like, I want all those people to be blown away And instead for really good care to come from quantum, I'm a very obviously, competitive person. And I kind of want to cure that for the people who would fall into other people's hands and then just help them move the needle for everybody, especially women. So we just get farther faster with all our money. And
So
then
we
we can do
just,
so much with it.
thank you. Should we just email you then if we want to go through a scenario with you?
Yeah, absolutely. We'll have a personal conversation and we'll be able to probably use some of these examples, so that you can say, yeah, I kind of liked that one. And we can drill down and then we'll find out your health and all that stuff. Yeah, there's the whole process of quantum is a very concierge level experience when we have a client that needs some support.
Cool. Thank
Yeah,
you.
do you have a calendar link that was in the emails that we can schedule ourselves with you?
Yeah, I do. It's at the bottom of my address.
Okay.
What we need to do actually is send you all the materials we reviewed, and I'll make sure that we send that out soon so you guys have access to what we covered and also
Sure.
the calendar if you have extra questions, and can email me if you have questions.
Perfect. Thank you
Cool.
so much.
Thank you.
Thank you so much. Really.
Have a safe trip.
Oh, thank you so much. Okay. Have a wonderful
safe flight.
weekend. Thank you.
Yeah,
Okay,
bye.
bye, guys.